given the market turmoil at the moment, so how is this playing out for ETFs? Is that a good way perhaps to manage your portfolio during times of uncertainty? Well, George Clapham is the portfolio manager of EQT 8 Bays Global Fund. He joins us now. George, good to see you.
Nice to see you too, Andrew. Yeah.
You would have seen market turmoil plenty of times before. How do you rate this one, what we're seeing at the moment, all driven, of course, by that trade uncertainty?
Well, I see this as being a healthy adjustment, a correction from probably an overvalued US market, pumped up post the election of Trump and the Republican domination of the two seats there. So, yes, there was expectations that there would be a Trump victory, and certainly, we found opportunities prior to that to make adjustments to our portfolio.
All right, in what sense? So you saw this potential uncertainty, given what we've heard from Donald Trump. How have you adjusted the portfolio?
Well, firstly, ETFs are a great way of getting exposure to various industries. We manage the only global equity fund which is predominantly US-based industry ETFs. So you can quickly grab a theme and buy a sector that you think is going to benefit out of geopolitical changes, out of other structural issues, and to some degree we saw some a bit of exuberance going into the large tech sector in the middle of last year, and you can take a position in another sector, reduce your position in that sector. So we took a underweight position in some of the sort of the mega cap techs. We still actually have exposure to a couple, and we moved into sectors which we thought were going to benefit from particular changes. For example, energy policy and manufacturing in the US. So there were two sectors that we took advantage of, and we invested in US pipelines, which you can buy in ETF form over there, for example, and that sector has benefited. We also took positions in industrials, defence and aerospace, those sorts of sectors. So the ETF structure is the most efficient way of delivering that sort of thematic within a portfolio, within a couple of trades. So we don't have to worry about, well, which sector, which stock, we take the vertical and we can buy that in an ETF. And in the US, we've been doing this for almost over 5 years now. So we had to go through COVID crisis, other tech meltdown crisis, and you can simply in a couple of trades get your exposure to those sectors that you think will do well and reduce your exposure to those sectors that you think are problematic.
And do you stand by that? So looking at exposure there, US oil production, manufacturing, given Trump is looking at onshoring, and obviously we see that play out in terms of its protectionist policies. And you're likely to stay there for a while, do you feel?
I think so. I mean, just last week we saw TSMC and Eli Lilly announce something like $130 billion of expansions of plants across America. A lot of that was ignored by the market because they were worried about the tariff issue, etc. I would point out that tariffs, whilst they are a negative in the short term, it will be a one-off blip to inflation. It's not like it's a sustainable change in inflation. So and if you look at US bond markets, they've actually rallied. Rates have gone lower. So it's sort of the inflationary impacts of tariffs are one-off.
But
so that's constructive for equities generally.
But you obviously need to remain agile, given it's pretty unpredictable, though, isn't it, what we're likely to hear from Donald Trump, and just in terms of those policies?
Well, I probably think a lot of the predictions were there. He was declaring this, and even though Elon Musk he's been called unelected, he was on the podium with Trump at just about every rally, pointing out the issues, and Musk's position is with Doge is to reduce government spending. So again, you can say, well, you don't want to be too exposed to government sector, So those themes were there.
So are you looking at opportunity only in the States at the moment? What about elsewhere, aside from Australia, which I'll get to in a moment? What about Europe, given it's actually outperformed?
Europe has outperformed, and we have had some regional shifts. Whether that's sustainable, I question, because the way we look at the world, we look at the world through industries, global industries. So which global industry is going to do well? China's done well. China Tech has done well. But broadly, you can get those positions in the US ETF market, because the US ETF market will have large amounts of European, even Asian stocks within those verticals. So you can buy a sector, for example, like robotics, and you'll have major robotics companies from Japan through to China to whatever in that one vertical. So thematic investing, which we've been doing for 5 years, is a good way of getting exposure, and just using the one market which is the cheapest and the most liquid market, is the easiest way to go about it.
What are you seeing locally at the moment?
We haven't got any much exposure at all, or no exposure to Australia. We're purely global industry ETFs. We've been running that strategy since the end of 2019. We've delivered something like 19% CAGR during that period. In the last 2 years, we've done 32%.
And why is that?
Well, first of all, our strategy is somewhat unique in Australia. No one's using ETFs as a way to implement their investment strategies. Most people are bottom-up or stock pickers.
Yep.
We are sector or industry pickers. And we saw that the US industry ETF sector, which is a 1.2 trillion market, as an opportunity to bring that to Australia at the end of 2019, 2020. So you can see by the shift in funds to ETFs that these strategies are being implemented globally, and particularly in the US. It's not that uncommon, but yeah.
And George, aside from what we're hearing in terms of the Trump administration's policies, what did you make of the past reporting season, and what any sort of guidance you managed to pick up in terms of earnings going forward?
Well, it was a fascinating reporting season. The big themes that came out of the reporting season was the amount of money that is being thrown into generative AI, and the hyperscalers. We're talking 350 billion of capex going into that, and we saw the announcement of TSMC the other day. So those capex numbers were well above consensus expectations, and to some degree that's a negative for earnings in the shorter term. But if you read the transcripts of Andy Jassy, which is the largest player in that market with AWS, they're finding the capacity that they're putting in is being used up very, very quickly. So the demand is there for generative AI.
There are questions being asked by investors, though, in terms of that capex. Simply, given what's happened with the rise of DeepSeek, is that relevant, do you think?
I think DeepSeek's also another blip, but we see, and obviously this, Alibaba came out last week with another large language model, but certainly one of the Broadcom reported last week, they're talking another 70% increase in the demand for ASICs and their products, which are going into hyperscalers. Nvidia's still got quite a good growth trajectory. All of these stocks have come back, obviously. Nvidia was incredibly expensive. It's now about 26 times earnings. So, but that is the big theme, is that capex in that space. So I suppose the other theme coming out of was really defence, the defence budgets in the world. We're seeing that with the large defence companies like Lockheed Martin and Raytheon, etc. They're expected to grow their books as European defence spending increases as a percentage of GDP.